Good morning. Can you all hear me?
Yes, good morning. We can hear you loud and clear.
Good. And the ladies?
Yes, we can hear you.
Good. Okay, we'll just wait a couple of minutes to see if we get a few more people joining, although we've had some apologies that they can't attend this morning. But as Miguel's mentioned before, the recordings are always available, so they're a useful tool if you kind of miss out the session. Also, some people like to use them when they're making revision towards the end of the program, just to refresh themselves on what was actually said during the workshops. So just 2 or 3 minutes, and then we'll make a start. Okay, then let's make a start. So if you can find, where we got up to last week, where we started to talk about the business performance ratios. Just give you a moment to make sure you can find that. So just to recap, when we're, getting involved with small or medium-sized businesses, one of the key skills we will need is, to be able to analyze how the business is performing, because that will help you, in your role as a financial planner. And probably the best way really is to use a series of business ratios, to see whether things are getting better in the business or they're getting worse, or is it a bit of a mixed trend. So I know at this stage it's a bit of a chore, mathematically, but what we'll do this morning is we'll begin by going through that first year of ratios from the ratio spreadsheet, and I'll go through those, one by one with you. And then what we'll do to save time is I've already sent Miguel a ratio sheet, which he will put into the chat box and also email you, so you can see years 2 and 3, and that'll aid our discussion. So the whole purpose of doing this, so we can see the trends in the business performance, which will be very helpful to you to see how the business, is going along. And then it will also give you the ability to develop a list of very, pertinent questions appertaining to that particular business. And we'll do that on the clothing imports case study. So it will be, like a real life example. And then when we start next week to progress into the relationship skills side, one of the key situations that you'll be in will be, business interviews and meetings and discussions and things like that. So this preparatory work, as some people like to call it, doing your homework, we'll find is very, very important. And I'm pleased to see that Candice has joined us, because she did promise us she might work all those profitability ratios ready for this week. But I'm not, if you've been too busy at work and with your family life, don't worry, because as I was saying, we're going to go through the first year together on the other ratios, and then I've got a ratio sheet prepared here that I've sent to Miguel, and we can, just pick up year 2 and 3 without doing the maths, and then we can start looking at the important area of what do these figures actually tell us. So yeah, good morning to you as well, Candice. So let's make a start then by picking up where we left off. And if you can refer to your notes, which will be really important to when we come, to the relationship skills module, because, we will come back to clothing imports, and we'll come back, to the John Edwards case. We'll come back to Jane Brown, and we'll also have some fresh cases like a grocery food store where he wants to expand the store, and that one's also linked to two videos actually, which will demonstrate some interviewing techniques, and we'll also have a business startup situation to look at as well. So anyway, let me get back to this morning without talking for too long on this. So the profitability section on the spreadsheet, we had sales growth in year 1 not applicable because we didn't know the previous year to do the mathematical change between the 2 years. Then we had gross profit percentage of 10%. We had the operating margin, which, as I explained, was the profit before interest and tax. There it is there at the bottom of this page. And that's the American analysts' EBIT, earnings before interest and tax, the same thing. Then we had the pre-tax profit margin. And then the one that was missing off the handout was the bottom line position, very important. And good morning to Dimitri there joining in. Then the bottom line position, the net profit, we calculated at 1.9%. So as I say, in a few minutes, we'll bring in years 2 and 3, which I've already worked out. So let's look then at the next section on the spreadsheet, which was the section that some people call the liquidity section. Some people call it efficiency. So once again, you've got to kind of struggle a bit with the two terminology, but you'll see here, the first ratio there is the very traditional accountancy ratio. So this is, this is found in many accountancy textbooks when they talk about working capital. And the straight definition is the working capital equals the current assets minus the current liabilities. So that's what we're going to work out to begin with. A bit later, as we progress through module 2, I'll look at a more modern approach with you, where we look at the actual working capital that's required, as opposed to this straightforward, balance sheet calculation. Don't get me wrong, the calculation is important, but we always have to remember, these figures won't be right up to date. So let's do that together. So working capital, I need to flick back to the case study, which, no, it's not that way, it's the other way. Here we are, clothing imports, case study, balance sheet, year 1. So this comes straight from the balance sheet, as does the other 2 ratios in this liquidity section. So we've got working capital equals current assets minus current liabilities. So you can see there, total current assets, $285,000. And then the total liabilities, current liabilities rather, $250,000. So one from the other is $35,000. And on this occasion, the accountant's been quite friendly towards us and they've worked it out, but they're calling it the net current assets. So 35,000 goes into our ratio sheet. Now let's look for the next ratio. So the next ratio in this section is known as the current ratio. Now, some people have a different way of calculating this, but most times it's calculated in the manner that we're showing you here. And this is the manner of calculations, that's been approved by the Chartered Banker Institute, so we got that badge on what we're doing here. Current assets, this time divided by the current liabilities, will give us the current ratio. Now, a current ratio of over 1 to 1, will indicate that the company or the business that you're looking at will have a higher level of current assets than current liabilities, which generally is a good thing. But like all these things, we have to be careful, and we're going to need the skills as we develop, to get in behind the figures, so we can't just take a snapshot total analysis, by running some mathematics. We've got to look at the mathematics, look at the trends, and then try and figure out, what is it actually telling us. So current assets divided by current liabilities. So let's do that on clothing imports. Back into the balance sheet. So there's the current assets, look. Cash and debtors, 150,000 is the current assets. But the total current assets are 285,000. So that's the figure we had before. And this time we're going to divide it by the current liabilities of 250,000. And you can see you're going to get a little bit more than 1 to 1. Somebody shout out the calculation or put it in the chat box if you prefer. So you're going to get 1 point something to 1 for this current ratio. Anybody got the answer here? Well, it is Saturday morning, and perhaps your calculators haven't warmed up yet, or if you're using your phone, I make it 1.1 to 1 on the current ratio. Now, the third one from the balance sheet, Sapphires confirmed that. Brilliant, thank you. 1.1 to 1. The third one from the balance sheet. So you see, to begin with, all those profitability ratios were all from the income statement, so it was like a deep dive into the income statement, how it's performing in terms of ratios. All these that we're looking at the moment are from the balance sheet. So here's the third one from the balance sheet. There it is, it's the quick ratio. This used to be called the acid test, but people don't like that, because of the modern linkage to other things. So we tend to stick to the original terminology, which was the quick ratio. Now, why is it called the quick ratio? The reason it's called the quick ratio is it's the same figures that we had in the current ratio, except what we do is we deduct what is generally the slowest moving of the current assets. And generally the slowest moving of the current assets will be the stock, or if you prefer the term, the inventory. So you can see the calculation there. Look, current assets minus the stock divided by the current liabilities. And this will give us what's known as the quick ratio. So this definition assumes that the company's stock is not easily turned into cash, whereas the other current assets will be quicker from a cash conversion point of view. So let's look at that from the balance sheet again. So this time we've got the current assets at 285, and we're going to deduct the slowest moving of the assets, which is the stock or the inventory at 135. So working backwards, we're going to get quick assets at 150. And this accountant who prepared these figures has been very friendly towards us. He's actually done that, or she's done it. And they're giving us a figure for the quick assets, which is the cash plus debtors, quick assets, 150,000. So this time on the calculator, you're putting in 150,000, which are the quick assets, and we're going to divide by the current liabilities at 250,000, and we're going to get 0 point something to 1. So 150,000, or 150 divided by 250, I make that 0.6 to 1, 0.6 to 1 for those liquidity ratios. So we'll come back and discuss more what they mean, when we've got the rest of the things done. Now, the next ratios that we're coming to is where it gets slightly more complicated, in that we're going to be jumping between the income statement and the balance sheet. So you'll see, to begin with, profitability ratios all from the income statement, those liquidity ratios all from the balance sheet. And now we're going to work some ratios which actually are extremely important, because they have a dramatic effect, as we'll see moving forward in the program, on the cash flow of the particular business. Now, the first one is, what credit is the business giving to its customers? Now, the way we look at this, we're going to be looking for the trade debtors, using the UK and the international term, or if you're using the American term, we're looking for the receivables, and we're going to divide those debtors from the balance sheet by the sales of the business. And this will give us an indication. It's not exact, but it will give us an indication of the number of days of debtors or receivables in terms of the collection period. So that'll give us a good indicator of how long it's taking the business collecting its debtors. So let's do that. So the debtors from the balance sheet. There we are, 150,000. And we're going to divide that by sales from the income statement. And there's the sales, look, 900,000. And because we're looking for the collection period in days, on this particular analysis that we're doing, the daily number of days would be interesting to do. So it's the debtor figure, 150,000, divided by sales of 900,000, and then we're going to multiply by 365 days in the year to give us the number of days. And I make that 61 days. Can anyone confirm that before we move on? So debtors 150,000 divided by the sales of 900,000 and multiply by 365 And I hope I hope you're going to get 61. Anyone confirm that yet? Come on, Dimitri, you haven't spoken to us yet this morning. You've been very quiet.
Morning, yes, sir.
Have you got your calculator going there, or your phone, or what? Can you give us that figure? 150,000 divided by 900,000 of sales, multiplied by 365. Anyone help out?
With 150,000 divided by
900,000. Then multiply the answer by 365. Wait till you get the answer before you multiply by 365. And I'm hoping you get 61 days.
900,000 divided by 150,000. And you said multiply by 365?
365 number of days in the year. Yep. Kohler and Candris, they're quicker off the mark. They've said yes, and they've confirmed 61 days. So I hope you get 61 as well. Just be careful that you generate the result before you multiply the result by 365.
Yes, sir.
Okay,
61.
61, excellent. Okay, now stock. Now stock, this ratio is where we have to be careful in saying, well, what we're using is the recommended ratio, but some organizations will take a slightly different approach, which I'll explain in a moment. So can you see, for us, what we're now looking at is the opposite, because what we were looking at with the debtors was how long it's taking, the business to collect the debtors in. Now this one is the opposite, and it's the trade creditors, it's the suppliers. So this time it's how much credit they're taking in days. So it's the creditor payment days, or if you prefer the American, payable days on hand. And this calculation is to look for the trade creditors. You have to be careful here, make sure it's the trading creditors, because there might be others that are not trading creditors. And the recommendation is we divide that not by sales, but by cost of goods sold. This is where I have to take a quick breath and explain to you that some analysts, you'll find some analysts will take the calculation as the trade creditors divided by the sales. So, just put a little notation against that we'll be using this, for this program, but you might come across a situation. You have to be careful when you're in a discussion, interpretation of things with clients, particularly if they've got their accountant present, because sometimes, you might come across something that doesn't look in line with what you think, and you've just got to be sufficiently confident just to say, well, can you explain, that calculation? Because I do know some of the ratios, are calculated in different ways, and that'll be fine. And they might give you a different calculation. Now, another anomaly with this is if you're dealing with a client from the Middle East, they use a multiple. Dimitri will be interested in this because he asked the question. They use a multiple of 360 days. And lots of the American analysts in the USA, they use 360 days because they work on every month having a 30-day accounting period. So 30 times 12 months gives you 360 days. So when I worked twice in New York, I asked them, why do you do that? What do you do with the other 5 days in the year? And, well, Americans have always got an answer for everything. So they did give me all sorts of strange answers like, oh, we've always done it that way and things like that, So there we are. So just be slightly careful with these. They're not written in tablets of stone, but these are the generally accepted methodologies that we're looking at. So here we go. Creditors divided by cost of goods sold. So let's go back into the balance sheet. And we're looking at the trade creditors. Well, there we are. Look, there's the creditors at 140,000. So you're going to put that in as the numerator, and we're going to divide that 140. You can just cross off the zeros for the moment. You're going to divide 140 by the cost of goods sold, which we'll get from the income statement. And there's the cost of goods sold. Look, in year one, 810,000. So if you can do that, get your result, multiply 365, and let's see who comes up with the answer.
63.
63. Anyone confirm that? Yeah, I've got 63. Yeah, I'll just wait a moment so you can finish the calculation. Sophia, yes, thank you. Okay, so that was looking at the number of days of credit that the business is taking. Now, the other one that's really important in affecting the cash flows will be the inventory or the stock. Candice agreed, thank you. So let's take a look at that. So let's go back to our analysis and look for the stock. There we are, look. Stock turnover in days is stock divided by the cost of goods sold again. So once again, some people would use sales. We're using cost of goods sold as the preferred method. So stock divided by cost of goods sold and then multiply by 365. So stock from the balance sheet. There it is, $135,000 and divided by cost of goods sold, 810,000. Multiply again by 365. And I get 61 days for the stock turnover. Dimitri's agreed that, thanks. So 61 days for the stock turnover. So just to pause the calculations for a moment, if I said to you then, Dimitri, oh, this clothing imports, the stock turnover is approximately 2 months, and you know they're working on these clothes that's being imported into the warehouse and then sold on to the various retailers. What do you think about that as a stock turnover? Do you think that's good or quite good or a bit slow, or any kind of snapshot impressions on that?
You said that the stock turnover on a clothing store is 2 months?
Yeah, it's 61 days, isn't it? You calculated that. Yeah.
Mm-hmm.
So it's approximately 2 months. Is that good or bad?
And that's the that's for the entire stock, the turnover
Yeah, the
on
entire stock. Yeah.
For a clothing store, boy, I don't know. I would.
Yeah. It's a
I'm
tricky
not.
one. I'm sorry, I put you right on the spot there. Actually, so they aren't the clothing store. These are the clothing warehouse. So they're importing the goods, holding them in the warehouse, and then they sell from the warehouse to a number of retailers. Like you'd find in Bay Street, for example. Yeah. So they're not the end outlet. When you go into the shop and buy the clothes, that's the end outlet. So the wholesaler is like a middle person. So what do you think about 30 days? Anybody? 60 days rather. Hard to tell, hard to make a judgment. So let's park that one for the moment. I mean, it didn't sound too bad in terms of the fact that it's a warehouse, yeah? If it was the actual shop in Bay Street, well, maybe we'd hope for a bit of a quicker turn than that. But it'll be more revealing when we also do the stock turnover levels for year 2 and year 3. So it's always a bit dangerous just to take 1 year in isolation. Okay, so we've got that. Now there's only one more, I think, in this particular section. Let's have a look. Yeah, now this ratio, asset efficiency. Now I have to tell you now, you know, for over 30 years we've been doing this, you know, thing in terms, you know, of all the financials and non-financials and this, that, and the other, and different spreadsheets. This ratio, I have to be honest with you straight away to say I have hardly ever seen any analyst working this ratio. Nevertheless, we put it in this program, we put it in the credit program, because it is, in my opinion, a very important ratio, because what it does is it takes all of the sales in the business. Now, you know, the sales in this business, I think we had approximately 1 million sales or 900,000 of sales. And then what it does is it takes all of the assets, so not the current assets, not the fixed assets, all the assets in the balance sheet, you know, so that's like the total investment of the business in assets. And then it looks at those relative to sales. And this will give you an indication of how many times all of the assets in the business are turned over relative to sales. And I think that's a good thing to look at, because it'll give us an indication, you know, of how efficiently the business is actually using the assets, and you get some widely differing results. A widely different result for you, those of you actually working in a financial institution, if you take your institution's balance sheet, and you'll find the total assets in the balance sheet are going to be pretty large generally. But then when you look at the sales, and your sales are, you know, like the income generated earnings through interest charges and through non-interest, which are things like commissions and facility fees, etc. So that's the figure you'd have to take. But generally, when I've done this on financial institutions, you get a 0 point something, which explains why, you know, working in a financial institution and getting good business performance isn't that easy to achieve, because you're utilizing a lot of assets relative to the income generating ability. So let's do it on clothing imports. So the sales in year one were 900,000. There we are. And we're going to divide that sales figure by all of the assets in the balance sheet. Now, when you look at the balance sheet, it can be presented in a number of different ways. You've just got to kind of persevere. So what we're looking for is the total assets. So the total assets will be the current assets plus the fixed assets. So we've got current assets of 285,000. Excuse me. Then we've got fixed assets further down, look, of 51,000. So if we add those together, we get $336,000 of total assets involved in the clothing imports business. And then we're going to divide that figure into the sales. So at sales, 900,000 is the numerator, put in 900, and then divide that by the total assets at 336, and you're going to get an asset efficiency figure. Now, it won't be a percentage this time, it won't be a number of days this time, it'll be just a straightforward figure. And I make that 2.7 to the nearest single decimal point. So try that for yourselves. 900,000 divided by, Dimitri's got it, yeah. His calculator's obviously warmed up now, or his phone, or whatever he's using. That was very quick. The 2.7 is the number of times clothing imports turned over all of the assets in the balance sheet relative to their sales. Now, you know, I think that, and I always have done, I've always thought that's a powerful ratio, but as I say, hardly anybody ever uses it. So I'll be really pleased moving forward if you use it in your work one day.
So, Mr. Checkley, I have a
Yes.
question.
Go on.
Um, so if a stock is turning over too quickly, then that obviously means that the company, the demand for for that particular, I would say, item
Uh-huh.
is too high for the company to produce. And if it's turning over too slowly, then it means that the company is not producing enough of a, or not generating enough of a sale in order to be relevant. So what would be a good ratio
Yeah.
between turnover? Are we taking into consideration, okay, if it's 2 months, 2 months would be good because now it gives the company time to restock. But is there, I guess depends on how the balance sheet looks and depends on the asset
Yeah.
versus liabilities. If
Yeah.
there's a if there's a break in between restocking and the demand of the sale, would it
Yeah.
negatively impact the company?
There's not an optimum figure is the answer. And all you can do is, to start with, we look at the trend over the 3 years. And then the next thing we'd want to incorporate some of the non-financial analysis, that Candice mentioned early on when we first met. And then we'd also want to incorporate, in this particular case, probably making a visit, a site visit, as you called it last week, Dimitri, to the warehouse to have a look. Because if we think I'm prejudging, but if when we work year 2 and year 3, this stock turnover gets slower, yes, so in other words, it's more days and then more days, in a way that's a red warning flag, because it indicates that the stock isn't being sold as quickly as before. So in that case, we definitely would want to make a site visit to have a look at the stock. Why would we want to look at the stock? If the stock turnover is slowing, if it's getting slower to sell, why would we want to look at it in this warehouse?
I guess to make sure that the stock is actually there, or to make sure the
Exactly, to make sure it's there and make sure the quality. Yeah, so you almost answered this question from your comment before. Don't forget, clothes tend to be fashionable, don't they? So what's in the stock that might potentially, not be that saleable at the moment? Fashions change quite quickly, yeah? One of the early programs I did in Jamaica, it was face-to-face in the room, and you could see the people sitting at the desks. It was nearly all Jamaican men on the program. And, you could see underneath the desks, a lot of them were wearing jeans. And we were doing a particular case study, which included items of clothing. And I said to them, oh, well, this business could have a lot of stock that's currently unstable and unsaleable rather, and you'd find that by making a site visit. I said, for example, the jeans could have very wide bottoms, that the bottom flared, and nobody laughed or anything. And I looked and quickly found out the reason why. Most of the Jamaican men in the room had jeans that had the wide flared bottoms, which in the UK had gone out of fashion. But of course now, jeans with wider bottoms have come back into fashion again. So yes, we'd want to take a look at this stock. As the case study progresses, Dimitri, and then when we pick up more of the relationship skills next week, on this case and the others, we'll see where all these things start to fit in together. So quite often there are no benchmarks. Quite often what we're looking for is trends, and then we're looking for the effect on the business. There will be certain of the ratios where we can get the chance of some benchmarking, and we'll come on to that later. So let's keep it moving on. So we had 2.7 times for the asset efficiency. Now we're nearly there with this first year. And now we're coming to the financing ratios. And again, these are the three, kind of ones that you'll come across a lot. Now, interest cover, very important. And you mentioned to me when we were talking about the consumer side, looking at the personal net worth and looking at the personal budget planner, and 2 or 3 of you mentioned, things like over debt service ratio and things like that. Well, what this is, this ratio for interest cover is not debt servicing, but it's looking for the coverage of the interest from the business. Now, how we do this is we take the net operating profit, which you might already remember. If not, you will by the end of the program. The operating profit's a good ratio to memorize. Operating profit is the profit before interest and tax, or EBIT, earnings before interest and tax. Good thing to memorize, because quite often in business discussions, particularly if there's an accountant in there, they could be talking about operating profit. So you'll have to remember what this is, because when we look for profit, as we discussed last week, yes, we want to look at gross profit, operating profit, profit before tax, and also net profit. So generally, bankers generally tend to think, right down to the net profit position, but lots of business people and accountants, when they think about profit, they will also think about the operating profit. So this interest cover is an important ratio. So it's PBIT divided by the interest expense, and that will give us interest cover. So let's try to do that. So both of those are going to come from the income statement. Here we go. So there's our operating profit, $33,000. Divide that by the interest of $8,000, and you're going to get interest coverage of 4 point something. Yeah, 4125, but we're going to approximate it, like we recommended before. It looks too academic. So we go to 4.1. Yes, so we go to 1 decimal point. 4.1. Now that sounds quite good. So the business is operating and it's covering its interest by 4 times from the profit before the interest and tax. And don't forget, by the time we get to that line, that operating profit line, there's been things deducted like the administration and distribution expenses, excuse me. Now, this is a ratio where I can't give you a traditional benchmark, but time has passed by a long time on this ratio, but it's worth knowing it, in the back of your mind. Traditionally, we would try and look for 2-to-1 interest coverage, because that would give us a bit of a buffer, where it could slip to 1.5-to-1 or 1-to-1, and the business is still covering, the interest position. It's when it slips below that position, they're not covering the interest. So that would be a red flag. So that's the interest coverage for the moment, 4 times, which looks quite healthy. Now, the other one to look at is, we're nearly there. We've only got two to go. Leverage. Now, we have to be careful with the leverage calculation, because in a financial institution, the leverage calculation recommended by the Basel Committee, and no doubt by your central bank, the leverage calculation will be all of the liabilities divided by the net worth position of the financial institution. But in each and every other business, other than the financial institution, leverage is looking at the liabilities, all the liabilities. So not just current liabilities or long-term, all the liabilities together divided by the net worth position. So that will illustrate to us, how much liabilities are in the balance sheet relative to the net worth. So let's try and do this. So we want the leverage. So this is all of the liabilities, the current liabilities and the long liabilities. So let's have a look. There's the current liabilities, look, 250,000. Let's see if there's any long-term liabilities. Yes, there are there, look. Long-term liabilities, 6,000. So the total liabilities in year one are $256,000. And we're going to divide that by the net worth. Now, as I explained to you last week, towards closing, if we weren't sure, if you add the current assets, the fixed assets, that will give you the total assets in any business, no matter how complicated it looks. And then if we add the current liabilities and the long-term liabilities, we'll get all the liabilities. And if we take all those liabilities away from the total assets, we should get something that we can call the business net worth, just like we did with the personal net worth. Now, the reason I always recommend that is because the net worth might be presented in different ways. And if you want to get a good example of it being presented in different ways, have a look at your own financial institution balance sheet and look for the net worth position. It could be, it could be shareholders' funds plus reserves. It could be a revaluation reserve. There could be this, that, and the other in there. So it can be quite difficult sometimes. But by using that simple methodology, you can definitely identify what the net worth is. So let's just do that very quickly on this, because I think the net worth is $80,000. It's not 20, which is the capital, and it's not the profit and loss that's been retained at 60. I think it's 80, but we should prove that. So if we prove it in the way I just said, if we have the current assets to the long-term assets, which are the fixed assets, and you did this a few minutes ago, remember we had total assets of 336. And then if we add all the liabilities together, and again, we did that just a few minutes ago, we had the current liabilities of 250,000 plus the long-term liabilities of 6,000. So we had 256. So we got total assets of $336,000, total liabilities of $256,000. Take one from the other, and with a bit of luck, you'll get $80,000, which proves what the net worth is. Now, I hope you'll find that calculation very useful, because it's really good, in my opinion, when you look into the balance sheet and you're thinking, goodness me, I can't really make head or tail of this. And of course, that's the last thing you want to be doing as a financial planner. When we move into relationship skills, you'll see an interview on film which illustrates an interview where the person concerned really does not understand the accounts, and he makes all sorts of, erroneous comments to the business person, and we don't want to fall into that trap. So if you pick a business that you like, from the internet, download the balance sheet from the investor relations section. Have a look at the balance sheet first glance. You might think, oh no. I mean, you could do Walmart if you want. We've done that before on the Wealth Manager program. And, take a look at their balance sheet and make you take a few deep breaths, partly because of the size of the figures, but partly because of the layout. But if you do that simple methodology, you should be able to figure out the net worth. Is everybody okay with that calculation? Or do you need me to do it again? Because I do tend to go a bit quick on some of these things.
You can go over it again briefly, please.
Okay, sure. Okay. So what I'm saying is, here's an example here. The way it's presented could be different the way one's presented to you. Some things in the past that have been changed, I don't think the changes have been for the better. When I first went into all of this, the balance sheet was called a balance sheet because it actually balanced, and it was left and right. So what you had is you'd have all the liabilities listed on the left, and you'd have all the assets listed on the right, and then the two totals would match up. But as time went by, the accountants moved to like different types of vertical presentation, which this is, and I don't think it's quite as clear. So what you can do is, if you're not too sure, when you get to this bottom position where you're looking, well, wait a minute, what is the actual business net worth in the business? If you're not sure, for example, oh, is it the share capital at 20,000, or is it the share capital plus the retained profits at 80,000? If you're not sure, and there'll be examples where there's a lot more entries there, this is what you do. You take the current assets, add on the long-term assets, which is the fixed assets. So you'll get a figure for total assets. Some accounting presentations will give you that figure. Some won't. They don't give it to us in this particular case, so we've got to actually do it. So there's the current assets, 285, plus the fixed assets at 51. So we've got total assets, if you want to write that down, it's $336,000 in year one in the clothing imports balance sheet. And then what we're looking for is the total liabilities, so we can take that figure away from the total assets to give us what the actual net worth is. Just like on that personal balance sheet we did. Remember, list the person's assets, all of their assets, list the liabilities, and you'll end up with a personal net worth, we hope, which would be positive. You know, sometimes it could be negative. It could be negative, for example, if they've got more loans, you know, than what the main asset is. If they're a property owner, real estate owner, and the value of that has gone down a bit, you know, that value might be less than the loans outstanding. So then you'll have a negative net worth position. And sometimes you'll get this in a business. If a business has a negative net worth, they have to seek assurance, you know, from their accountant in terms of continuing to trade. Otherwise, they could be classified as an insolvent business. In America, it's a bit different because they can, you know, file for protection, can't they, under Chapter 11 or 12? I can never remember which one. I think it's Chapter 12 protection they can file for. So in this case, we've got the total assets, we've got the total liabilities, or 250, plus the long-term liabilities of 256. And then just take one from the other and see if you get a positive figure. Well, you do. You got 80,000, yes? So you okay with that now, Candries?
Yes, thank you.
Great, great. So same with personal client, same with a small business. And you could do this on Walmart if you wanted, yeah? And you can do it on your own financial institution if you want. You know, look at the assets, total them all up, look at the liabilities, total them all up, and fingers crossed for you in your job, you know, that one from the other does give the business a positive situation. I don't know if you saw the headline news this week. Shell, did you see Shell this week? Of all the stock market listed companies in London, Shell have now declared the biggest profits of all time, 37, wait for it, not million, 37 billion pounds net profit over the last year. While people here, you know, haven't been able to afford, you know, gas to heat their homes, and petrol prices are sky high, etc., etc. So you might imagine there's quite a public outcry of that at the moment. Yeah, so as Cambry says, wow. So watch the space with Shell. So what we're going to do now then is we'll just take a short 5-minute break, and then during the break I'll ask Miguel to put that file into the Dropbox, and also to email it to you if you prefer that. And we look at the trends. So the good news is the calculations are already done for year 2 and 3. So when we come back after the break, we'll start to say, well, what do these figures actually tell us, which I'm sure, well, I'm hoping you'll find quite fascinating. Okay, let's take a 5-minute break. Okay, I didn't manage to get hold of Miguel at the moment, but you can see it. You can see it on the screen there. So just for the moment, if you want to make a note of the figures as we're talking, that'll be fine. Okay, so top line, to start with, the sales profile. You can see there's good growth there into year two, 16.7% increase in sales, and then moving up to 23.8%. So, he's achieved substantial increases in sales in what's probably quite a competitive type of business. So, that's quite a good thing. You can see there's a comments box on the right there where you can make a few comments. Now, the next ratio to look at, you can see, is the gross profit. So remember, we have sales and then we deduct the cost of sales or cost of goods sold, whatever it's called. And that gives us the gross profit. Sometimes businesses call this the gross margin. So the same thing. Gross profit, you can see the gross profit 10%, 9%, 7%. Anyone want to make a comment on that? The gross profit position.
It's decreasing year over year.
Yeah, it is decreasing. And it's quite worrying because what we see, in wholesaling businesses, I was trying to explain, they are importing these goods and then selling them to the retail stores. So you can see wholesaling, when you look at this gross profit margin, wholesalers' gross profit margins can be quite fine. And this is quite a fine margin. And the worst news is the deterioration. So it's deteriorated to only 7%. So this is what I mean by analyzing the business. So this gives us straight away, a good question that we could be asking the client. Well, we've noticed that, your gross margin is deteriorating. Were you aware of this? And can you explain, what's been going on? Now, the worst case scenario would be where the client, has no idea about what you're actually talking about, and they know the sales have been going well, but they didn't realize the margin, the gross margin on the sales has been declining. Why then, Dimitri and the others, why could the gross profit margin be declining? Now, it can only be one of two things or two of two things. Just think how it's derived. How is it derived from the income statement? Well, remember, it's the gross profit divided by the sales. So sales have been increasing, but the gross profit is going down relative to the sales. So why, what could this point to? It's only speculation at the moment.
The cost of goods is
Yes.
either
Yeah.
It's increasing, yeah. All the
decreasing.
ladies saw that, yeah. Andres, you had a comment there, or was it someone else? Someone was coming in, I think.
No, yeah, I was going to say the same thing, that the cost of the goods was increasing as
Yes.
well.
Yes,
So
yes. So that's interesting observation. Now, if you look at the opening point of the case study, if you got it like to hand, it explains, he's importing from overseas. So what that would suggest then is, the overseas suppliers have put up some of their prices, and he hasn't been able to, recover that in terms of his sales. So although sales have gone up in volume terms and monetary terms, the problem that he's got in dictating that gross profit margin is the cost of goods sold have gone up. So again, so we could start the conversation, and I'd always recommend this with business people if if you want to get the conversation kind of warmed up. Don't necessarily talk about baseball in the US, or cricket in the UK, or the weather or things like that. You could start talking about the sales, because every business person I met, like I told you before, they've always been aware of what the sales are. So that's a good place to start. And you can say, well, you've done really well in terms of the sales growth. We see you've grown, by almost 17%. And then in the next year, you actually grew by almost 24%. So that's very significant. And we could talk about how they've achieved that. Now, when I said it's one of two things or two of two things, but it's got to be one or the other, one observation you've already made is the cost of goods sold increasing, but the other observation could be selling prices have been reduced, relative to the goods and relative to the lines that he's been selling, which might account for why, he's got this increase, because he's been discounting the selling price. So again, there's plenty of things to talk about already, with this client that might not have been quite so apparent, from you just kind of flicking your way through, the balance sheet and the income statement. I mean, some people have been doing it so long and they're so skilled at it, they can do it by just looking at the balance sheets, looking at the income statements, and maybe getting the benefit of the cash flows, and they can make enough points to start the discussion going. But generally, what I'd recommend is you do this type of homework first, and then you have the interview, or then you have the phone call, or then you have the site visit, and it'll give you a lot more things you can talk about. So that would be my recommendation. Now, what about the operating margin? Well, there we can see operating profit. Look, that's declining as well. So that's like a double hit. His gross profit's going down. His profit before interest and tax is going down, and it's gone down as far as 1%. And then, goodness me, look at the next figure. Now, Miguel, if he's still online, would be quite horrified by this, because he's always a bottom line person in terms of the net profit. 1.9%, which was quite fine to begin with, then 1.5, and then 0.15. So he's down to less than 1% as a net profit margin. So what do you think about that, anybody? Anybody want to make a comment on the profitability ratios?
He's going to be closed in a year.
Yeah, well, that's very smart, because if that trend was to continue, you can see how much of a deteriorating trend it is. He's going to go into a negative position, which might force him to go out of business. But it's not just a case of profitability alone, because you'll meet businesses in Nassau where they make a loss, but they still survive. They manage to survive in one way or another, through the cash flow. And we'll come on to that in great extent as well. Working capital, well, this is from the balance sheet. So you see the balance sheet gives a rather conflicting message, in my opinion, with a snapshot judgment on a traditional accounting-based ratio. Oh, look at the working capital. Oh, look, the working capital surplus has increased from 35,000 to 53. Okay, it's leveled off a bit, but it's still better than it was in the first year. Anybody get behind that figure? So this is quite a leading question for you. So, on a snapshot view, the liquidity of the business, although the profitability has been declining significantly, the liquidity of the business from the balance sheet looks better. So what's that made up of? So is that a very good figure for us to be homing in on? What do you think? Why does it look better? What goes into it? I'm just struggling a bit to get my balance sheet back on the screen, but you can see the working capital figure there. So what's the working capital made up of? How did we get that calculation? From the balance sheet, current assets minus current liabilities, yes? So have a look at the current assets in the balance sheet. So why has this figure improved, this accounting ratio of the working capital position? What's driving the improvement? Now, I know all this part's tricky if you've not done this kind of thing before, but we'll have a repeat of it in module 2 on at least one other business.
Well, based on the formula,
Uh-huh,
which is current assets minus current liabilities,
correct.
it kind of shows that the client has a lot of assets on their books. So maybe they have a lot of inventory.
Well, maybe. I mean, can we be more specific than a maybe? Because you've got the figures there. What have they got a lot of in the current assets? Then how has it been moving over the 3 years in the balance sheet? What I'm trying to do here is get behind the formula. Yeah, we know what the formula is. We see the result, which gives an indication that the working capital looks better. But is it really better is my question. Now you can answer that. You almost answered it. So just persevere a little bit further with what you said.
Mm,
You said maybe he's got a lot more inventory. Has he not? What's the stock position, the inventory position?
it increased year 1,
Uh-huh.
5.
So shout the figures out. What's the figures?
Okay, for the stock,
Uh-huh.
he had 135,000 in year 1.
Yeah, stock, right? Uh-huh. Then year 2,
Year 2, it increased to 190.
190. So that's 60,000 more approximately.
Yeah,
And then to
and
year 3.
he increased to 257,000.
Wow. I mean, that's huge, isn't it? So he's got about $250,000 in inventory. So Dimitri, what do you think about that? $250,000 in inventory. Good or bad?
Depending on how quickly he's moving the stock, it could be good.
It could be good, but it could be bad if there's a lot of stock in there that's fashion conscious and is unsaleable, yeah. So what we're saying is when you get this working capital figure, yes, it's important to do it. You know, it's a very traditional ratio, but you have to be careful because although the answer appears to be better, moving from $35,000 to 53, when you get behind the figures, as you've just been discussing with me there, what's driving the figures is that huge increase in inventory, which could be good, or it could, you know, have some hidden problems. And then what's the other figure in the current assets that's driving it? Come on, what's in the current assets?
It's the quick assets.
No, don't go for the quick. What's what's in the current assets that can also be driving a result that might not be as good as we first thought? What's the other big figure in current assets?
The debtor.
Yeah, the debtors or receivables. Yeah.
Mhm.
And what's happened with the debtor figures? Shout them out like you did before. What's the debtor figures?
It was 150,000 in year one.
Right, so that's the amount that the business has outstanding to its customers. So they want, you know, they've got to collect these in. So quite like the American term on that, which they call it the receivables, yeah? So the receivables due to clothing imports or the figure that you just said. Now, what happens to that figure in the following year?
It increases to 170,000.
Okay.
And then
then,
in year three, it increases to 230,000.
yeah, 230,000. So if you take the inventory and you add on the receivables or the debtors, can you see you've got almost $500,000 tied up in those current assets, haven't they? Can you see that? I mean, that's a huge amount of stock to try and be selling, and a huge amount of debtors. Now, just like with the stock, what we need to do is discuss it with him. You know, is there anything unsaleable? Blah blah blah. You know, best case scenario, it might be all fine. That would be great if it's all saleable. Then the debtors. What's the problem sometimes in collecting in receivables? For
There's a
those of
chance
you-
that your customers won't pay you.
Yes, you guys should know this. The ones who are bankers in the audience, yeah, you'll know. I mean, the bank's receivables, you know, are the loans that's outstanding, aren't they? And the overdrafts, yeah. And as you just said, sometimes people don't pay. So what we'd need here would be a discussion on the receivables because it's a very significant figure. Okay, so progressing this discussion a little bit further, if some of the items in the stock aren't saleable, what will that mean in terms of the future cash flows? Will it be good or bad for the cash flow going forward? If they can't sell all of this stock, is it good or bad? Impact on the cash flow. And if you're not too sure about that, think about the receivables. If some of those receivables, those debtors don't pay, is that good or bad for the cash flow?
I think it would be bad for the cash
Yeah, of
flow.
course it would. It'd be bad for the cash flow because if they don't pay, the cash doesn't come in, does it? Yeah. So you've lost a source of cash flow coming in if they don't pay. So again, you know, the analysis of who these debtors are, how many are there? Yeah. Now, if he's got 1,000 debtors all owing a small amount, that's not so bad as if he's only got maybe, you know, 4 or 5 retail outlets that all owe him, you know, big amounts of money, and some of those might be, you know, difficult to collect in. So these are really really important things in terms of the cash flow. We're getting there. Everybody okay so far? So similarly, the current ratio and the quick ratio won't really tell us a lot for the same reason. The same sort of figures are in there. So what we're saying is the profitability side of our analysis was much more straightforward in this particular case study. You know, we can see it's all deteriorating, except the only good thing is sales were increasing. When we come to those balance sheet figures, they're slightly misleading and don't tell us too much. So let's move on to the next section and see if they give us some better indicators. So we talked about the debtors, and we talked about the debtors in terms of the amounts. Now let's look at the debtor collections. So before, he was collecting his debtors in 61 days, that's about 2 months. Then it improved slightly to 59 days. So they're being collected in a little bit quicker. Is that good for the cash flow or bad? If you're collecting your receivables quicker, is it good or bad? Follow your common sense, right? You know, don't get all mystique over the mathematics. If you can
Would
collect
be
your debt,
good.
yeah, of course it's good. Yeah, you're getting the money in quicker. Yeah.
Yeah.
So the money's coming in, but it's coming in quicker. What about year 3? Good or bad? Bit worse, yeah.
That's
So
worse. Yeah.
yeah, not alarming. So it's about 2 months in year 1 and year 2, and slightly over 2 months in the next year. So that doesn't look too bad a trend. But here's another question we can come right in on. Oh, we see, you know, you're collecting receivables in, you know, approximately 2 months. But what's your terms of trade with your customers? You're supplying your customers with these goods. What's the terms of trade in your contracts? Now then, if he says, well, the terms of trade are the customers should pay in 2 months, well, then that's fine, isn't it? They're paying approximately 2 months. But if he says, oh, well, the customers, you know, they should pay in 30 days, that's the term of the contract, but, you know, sometimes they're a bit slow to pay and blah, blah, blah. Well, then you'd be more worried that he's not really on top of his receivable collection. See what I'm getting at? So there's a good question there. Terms of trade. Inventory. Now, Dimitri was, you know, was commenting on the inventory before, and you just commented a few minutes ago about the size of the inventory going up to $250,000, which looks, you know, a huge amount of inventory or stock to be holding. Now let's look at the trend. So this is the stock level turnover in days this time. So year 1, he's turning his stock over in approximately 2 months. Then it got slower. Stock turned to 73 days, and then slower again to 78 days. So is that good or bad for the cash flow?
Bad.
It's bad, yeah, it's bad, yeah. So what we've got so far is 2 items that will be affecting the cash flow in an adverse way. You know, the debtor's taking longer to collect in, and the stock taking longer to turn over. Let's look at the payables. So this is his trade creditors. So this is what he owes to those suppliers, you know, of the goods that he's importing. So 63 days to pay his trade creditors, his suppliers. Got a bit worse to 69. And then the final year, 84. So that's nearly 3 months to pay his suppliers. Come on, Dimitri, you're right on this one. Is that good or bad? Or is it a warning sign or what?
Could you repeat it? Which one?
Is that a warning sign?
For which one?
Creditors paying the payables, 63 days, then 69 days, and then up to 84 days, almost 3 months to pay his suppliers.
Oh yeah, that's
of the
bad.
goods. That's bad.
Yeah, it's really bad.
So that's too bad. So we'd want to ask about that. But we got the same question as we had with the debtors. So another key question would be, what are the terms of trade with your suppliers? Yeah. Now, if you said, oh, the overseas suppliers, the goods, they're really kind to me, they give me like 2 months credit to pay. So 63 is not too bad, 69 is not too bad. But 84, he's outside of his terms of trade, aren't he? In worst case scenario, what would happen if the suppliers said, well, you haven't paid nearly 3 months, so we're going to stop supplying you? No, then he would be in the predicament that Dimitri said he'd be bust or broke next year because he wouldn't have any supplies. So there's good questions to ask there. He might say, oh, well, actually the suppliers have agreed that I could have an extension of an extra month at the moment. So there could be, once again, a valid explanation. However, does that affect the cash flow? Yes. Will a move in paying his suppliers from approximately 2 months to approximately 3 months, is that good for the cash flow or bad? Now be careful, this is tricky. Is it good for his cash flow or bad?
I would say bad. Also because you would have to inquire on if there's a penalty from his supplier as well for delinquent payments as well, because that's going to affect what he owes. The reason it may seem good on the statement is because on the asset side, it's going to show that he
Yes.
has this liquid cash on his account. But
Yes.
as far as his liabilities that he has to pay out, when you would take the liabilities from what he owes versus that what he actually has liquid, it may put him in in more sort of a deficit. So I can understand looking at his bank account, he may say, I have $500,000, but based on what he has to pay out,
Yeah,
he may actually be in a bit of a deficit.
in a bit of a deficit, exactly. So we're going to discuss this again in a moment, but if we move down to the interest cover, so this is the coverage from the operating profit for the bank. Good coverage 4 times, and it plummets to just over 1. Still covered, but it's gone low. Look at leverage. This is all the liabilities relative to the net worth of the business. Now look at this, it's getting significantly worse. 320% leveraged, 325, then up to 451% leveraged. Now there's no benchmark on this, but as you can see, the higher it gets, it's looking pretty bad. Countries just had to leave, that's fine. And then what about the debt gearing? So this is the banker's favorite ratio. It's sometimes called debt to equity ratio, sometimes called just gearing, sometimes called debt gearing. So this is the relationship of, the debt to the business getting better or worse. Well, it got slightly better in year 2, and then it's got worse again up to 150%. Now, again, a traditional historic benchmark on gearing would be anything over 100% geared would be considered getting high. So the business would have to have good prospects to be able to cope with this high level of debt. So trying to summarize all this and trying to summarize where we're up to, we were quite happy with the increase in sales, but we're not happy with all the deteriorating margins under profitability. The balance sheet, because of those asset figures that we've seen, don't really reveal that much. The efficiency ratios, debtors will have a bad effect on the cash flow. Stock levels will have a bad effect on the cash flow. Creditors we need to explore, as Dimitri was saying, are there any penalty clauses, etc., etc. Interest covers decline, that's worrying. Leverage is increased, that's worrying. And debt gearing, it's got worse, so that's worrying. So all in all, quite a worrying situation we've got ourselves looking at here, and plenty scope for lots and lots of questions. So any comments so far on this? I mean, do you generally feel a bit uncomfortable with this? Or do you think everything's not too bad?
Yeah, it's a bit uncomfortable. Everything seems to be deteriorating year
Yeah.
over year.
Yeah, well
And the
said. Yeah,
second year and the third year always seems to be higher than the first and the second.
the first and second, yeah. So it's getting worse, and it's getting worse than worse, yeah. So a lot of scope for meeting with the client, a lot of scope for a site visit, to take a look at this stock, discuss the data collection, etc., etc. So keep your notes on this, because we'll come back to it in the relationship skills module, and we'll start to talk about how we would plan for the meeting with him, how we'd plan for the site visit, things we'll be looking for, and then we'd come to the very important part. Do we have any ideas about how this business might be turned around? Do we think it's possible to have ideas for a turnaround on this business? So keep all of that, keep your notes, and we're going to move on with a few more topics in the remaining 30 minutes or so. Okay, now I've got a slight issue here. Let me just try something. Okay, sorry about that slide. Technical delay. Okay, so we went through the ratio section. We started on clothing imports. The cash flow we come back to. Okay, now we have in the notes there, if you move a bit further on, the section on business startups. Which, if you've got the PDF files on page 33, if not, it's after this clothing imports case study. So general discussion, do you think business startups are generally successful, or in Nassau, do they have quite a high failure rate? Any comments?
I think they do have a high failure rate when it comes to general startups and business. Also,
Yeah,
depending on the market that you go into as well.
yeah. Why do you think they have a high failure rate? That's mirrored as well in the UK and in lots of countries globally. Business startups tend to have a high failure rate. Why do you think that would be? In your own experience. Yeah.
I think it all boils down to not only cash management but also financial management as well as small business.
Yes,
As you can see from what we're studying now, there are a lot of moving pieces that goes into
goes into it.
determining if a business is successful or not. I've always
Yes,
heard a rule that a small business does not turn a true profit until after 3 to 5 years.
yes,
Uh,
yes.
but what
Quite
you
often.
find
Mm,
what you find is a lot of businesses, once they start, they tend to take from the business before it actually has a chance to develop a trend and develop a true profit nature.
yeah.
But usually what I've seen is high cash businesses usually survive much longer than businesses where
Yes,
they have to deal with very large inventory and stocks and
yes.
payroll and everything else. Like
And everything else.
bars,
Mhm.
bars are usually successful for a long period of time because the inventory is the same and the
Yeah,
turnover is fairly quick.
and there's plenty of cash coming in usually. Mm. Yeah, so it's interesting your comment there, Dimitri. Yes, I mean, as I was just saying here, it's a difficult area for client evaluation. Is often there will be no track record, so it's not like clothing imports where we've got a few years figures we can look at. Business startup is a startup, so we'll need to look closely at who's behind the business. What are their skills? Do they have skills in the particular type of business they're coming into, the type of industry that they're coming into? So that'll be important. And what can we find out? So it's KYC again about their personal history. Why are they wanting to start this business? Will the business have a reasonable amount of capital, as Dimitri was suggesting? Because quite often, starting a small business, it can be quite a slow curve of progress. It could be year 2, year 3, year 4, sometimes year 5 before they really start turning in a profit. So they're going to need a reasonable amount of resources, of capital resources, to put into the business. And debt from the bank or other institutions, yes, that will help in terms of debt capital, as it were. But there's no real replacement for some capital coming in from the business proprietors to show their commitment and to help with the development of the business. So second paragraph, yes, we all want to help encourage successful developments of businesses, but startups do have a high failure rate. Problems frequently occur through over-optimism and the lack of managerial skills. Things you know. It's good to be optimistic, but you've got to have reasonable, realistic level of optimism. And if you see a business plan and they say we're going to do this, and then in 5 years we're going to be listed on the stock exchange, my advice to you would be to look at this extremely carefully because you know that's a real go for it attitude and possibly very over optimistic. Lack of managerial skills, you know, really important. Once again, crossing to the non-financial side, you know, what's the skills and experience of the people who are going to be driving this business forward. Also, as I was mentioning, it's essential there's a reasonable level of capital to be introduced, both as a level of commitment and as a buffer against loss. If a client is able to contribute a significant capital stake, it may give prospective lender confidence that future plans, you know, can prove successful, you know, so there could be a degree of patience required here. Now, this point's important. Some lenders consider, you know, if it's a company, that if the director gives a guarantee supported by a charge or a mortgage or a pledge or whatever over their personal assets, this could be regarded as a substitute for capital. But while such a guarantee is evidence of commitment, it does not represent capital resources because, you know, it's a commitment by way of a guarantee. So as we were discussing earlier about the balance sheet, you know, this is not going to appear in the balance sheet. You know, this is a guarantee, this is security, this is collateral. So it's not going to impact into the balance sheet. So don't get confused about that. Inadequate proprietor's capital can result in the business having a significant borrowing requirement going forward, the interest cost of which will raise the business's break-even point. So, you know, more debt relative to the net worth, like with stone clothing imports, more debt means, you know, more interest to be paid, and more interest to be paid raises the point at which the business will break even, and we'll have a session on the break-even analysis approach, which will help you, you know, in financial planning, looking at the different break-even points in business. A business with a low capital base will have to generate higher levels of sales and profits than one which is adequately capitalized, you know, because it's got more debt. You know, it needs this extra income coming in to service not just the business costs, but, you know, the interest and the debt retirement or repayment. Anyone going into business should have a planned approach. Now, this is, to me, this is always an interesting point, because you might be in discussion with some people and they're talking to you about starting their own business, etc., etc. And you say, well, do you have a business plan I could look at? You know, and there's like silence. You know, they haven't done a business plan. So it's really good for you to encourage them to at least, you know, start to commit to doing a business plan, because then there'll be areas that maybe they haven't considered properly that would be, you know, highlighted in the business plan or missing from the business plan. And here's a little bit of a checklist that we developed a long time ago. So if you're not too sure what should go in, you know, here's a suggestion for the clients. Well, why not start with the business objectives? You know, what are the objectives? Are the objectives significant sales growth and profits, or are the objectives quite conservative in their approach? You know, what is the objectives of the business? Very important. And sometimes a client might say to you, oh, we don't want to tell you that. You know, that's our secret. That's our secret, what our objectives are. Well, you know, in that case, I'm sorry, you know, we can't consider your business plan without knowing, you know, what you're trying to achieve. We've had instances given to us in conversations from previous courses where one client told the banker, well, I'm not going to tell you the objectives because I'm worried that you're going to copy my business ideas and my objectives. I mean, goodness me, you know. So there we are. That's a real lack of trust. Who are the management of the business? You know, is it a sole trader, a partnership, small company, etc., etc.? Dimitri mentioned the marketplace. Very, very important. What market are they going into? Yeah, Dimitri's put a message in there, lack of funding as well. Yes, that's a bit further down. You know, what's the outside finance requirements if they don't have sufficient capital? What's the marketplace that they're going into? You know, what's the type of market? Dimitri mentioned, you know, maybe like a bar, the leisure industries, what have you. People still tend to drink, you know, no matter whether we're in recession or the market's going well. What products are there in the place? Are they traditional products? Are they very modern products? You know, what's the future positioning on that? What about suppliers? As we saw in the clothing imports case, you know, who are the suppliers? Are there supplier contracts in place? What physical resources do they have? And that's by way of premises and things like that. What about personnel, people who are going to be working for them if they're employing a few people? And then coming to this section here, the profit and cash forecasts, very important. Now, when we start to talk about forecasts, generally there are two main forecasts that we're looking for as financial planners. That's the forecast of potential profitability and the forecast of the potential cash flows. And then the point that Dimitri made there, if they've got insufficient capital in the business, what outside funding are they looking for? So two main types of budgets, I've said. Now a client may ask you, well, which should I do first? Do I do the profit budget or do I do the cash flow budget? Well, in our opinion, it's best to start with the profit budget because it could take the client hours and hours to construct a cash flow budget or a cash flow forecast. But if they then look at the profit budget and it projects a loss and not a profit, you know, then the cash flows are instantly going to be changed because they're going to have to overcome these initial cash flow deficits. So we'd recommend they start with a profit budget. So in constructing a profit budget, what we're doing basically, we don't need to kind of invent the wheel, as it were. What we're doing basically is we're doing a projection forward of the trading and profit and loss account that we've been looking at, for example, with clothing imports, or you more frequently call it the income statement. Now the cash flow is different. We need this alongside the profit budget because a lot of figures are already available in the profit budget, but we need to restate this in terms of the timing. Cash flow is all about timing. It's the timing of the receipts and the timing of the expenditure payments. So the main difference really is one of timing. For example, if sales are sold on credit, such as they were with clothing imports, there will be a delay in receipt of cash. Purchases, if you take trade credit, payment will not be needed immediately. Now, this next chart is meant to help you if you're not too familiar with these budgets, and it's quite a handy template to have because, you know, sometimes people are not too sure what actually goes where. So in the profit budget, which, as I said, is, you know, projecting forward the income statement, there will be projected sales, projected, you know, cost of sales, costs, interest charges only. So any capital repayments, if there are loans, they won't go in the profit budget because that's capital items. Depreciation will go in because depreciation is a charge. It's a bookkeeping item. It's a charge on the fact that generally assets will depreciate over time. So the accountants are allowed to build in a depreciation charge into the income statement. What we'll exclude will be capital expenditure. That's cash flow item. grants, any sale of fixed assets, because that's cash flow, any loans or hire purchase installment credit, repayments, and any value added tax. Now, or sales tax, whichever you call it in Nassau. In the cash budget or cash flow forecast, you will need to include not the sales, but the sales receipts. If some fixed assets have been sold, that'll go in. Any capital expenditure needs to go in because that'll be cash going out. Costs paid, loans, hire purchase repayments and interest, value added tax, creditors paid for supplies, and the cash flow forecast should not include depreciation because it's not a cash flow expenditure. What it actually is it's a charge against the income statement. Depreciation is a bit tricky. We'll come on to that in more detail. So that's some of the items there. Sometimes if there's significant amounts of capital expenditure being shown in the cash flow forecast, we could ask for a budget on the actual capital expenditure. And there's an example there of a new van and an old van being disposed of. Now there's a section in here on franchising. I won't go through this like blow by blow because it just talks about, what a franchise actually is, and then some advantages and disadvantages, which you can read through. Can anyone think of a franchise style operation in Nassau? Anyone give me an example? So a franchise where an organization with a market tested product or service enters into contracts with individuals to set up and run their own business.
Wendy's.
Yep, Wendy's. Yep. Very good. I seem to remember, is it Wendy's Burgers? I can't quite remember. Or do they do fries as well? Wendy's fries?
Yeah, so
Yeah. So just on a final note then, Dimitri, what would be the advantage of someone wanting to get a franchise from Wendy's?
the advantages would be marketing is already completed. The suppliers will already be aligned as well, so you
Yes.
wouldn't have to look for suppliers.
Yes.
They're also aligned with your strategic financial position as far as profit margins as well. So
Yes.
when they are looking at the menu
Pricing properties and
pricing,
things. Yeah.
yeah,
Yeah.
based on the geological location of the franchise as well, they can assist with that as well. So
Yes.
having the franchise provides a business automatically with a lot of support that most small businesses don't have at the forefront. So
At the forefront. Yeah.
as long as you can manage your financial standings from the franchise, you're
Yeah.
more likely to turn a profit for sure.
General profit. Yeah. Brilliant. Really good explanation. Yeah. You've got the strength of the franchisor, in terms of the products, in terms of the product pricing, in terms of the suppliers, etc., etc. And they also generally will give you advice on the location. Location, would be very, very important, based on their knowledge of the background. Okay, well, that's it for today. When we meet next week, we move into the relationship skills, and it'll give us a chance to look at things in terms of, things like the interview, meetings, site visits, making, good preparation, rather, doing our homework before we get into these discussions, instead of being caught out on the spot, where you're trying to make instant conversations on something that you haven't had a chance to really look at. So my advice would be, if you get a set of accounts, if you get something a business plan. If you know, if you get this situation that you're going to be encountering, try wherever possible, you know, to set up a meeting or an interview or whatever a little bit later to give you time to study the material and do your homework, you know, get some questions, just like we did on the clothing imports case study, you know, where we did plenty of homework on that. I mean, sometimes you won't be able to do that, and sometimes you might just have to explain to the client, well, this can only be, you know, a preliminary discussion that you're happy to have, but you know, you're going to need a bit of time to look at the business plan, etc., etc. Okay, well, thank you so much for giving up your Saturday morning once again. I'll make sure Miguel sends out that ratio sheet to you by email. So hopefully see you again next Saturday. Thank you very much for your attendance.
Thank you. Have a good day, everybody.
Thanks, Dimitri.
Good day.
Good day. So are you there, Miguel? You there, Miguel?